What's happening in the world of finance? The Intuition Finance Digest gives you a unique take on the industry's major trends. A host of factors have conspired to act as a brake on Europe's economic growth this century, and the situation is not helped by inherent difficulties with financing the necessary measures to increase productivity. Since the beginning of the century, European policymakers have looked on the continent's slowing economic growth with concern. The situation is particularly pronounced when compared with the superior growth rates achieved by the US over the same period. On a per capita basis since 2000, real disposable income has grown almost twice as much in the US as it has in the EU. However, for much of this time, Europe's weak performance was masked by a largely favourable global economy. This was a period of vigorous world trade facilitated by expanded multilateral trading rules and a generally stable geopolitical backdrop. The US security guarantee also allowed European nations to reduce defence spending, providing a windfall that cushioned Europe's structural issues. But that era is now over. Russia's invasion of Ukraine has brought an abrupt end to the stability Europe once enjoyed, cutting off its largest energy supplier and exposing deeper vulnerabilities. Europe continues to trail the US in technology, with just four of the world's top 50 tech companies located in Europe. Meanwhile, unfavorable demographic trends, most notably a projected annual workforce decline of 2 million people, underscore the urgent need to boost productivity. It was against this backdrop that former ECB chair Mario Draghi was tasked by the European Commission to prepare a report with the title The Future of European Competitiveness. The report's intended to contribute to the Commission's work on a new plan for Europe's sustainable prosperity and competitiveness, with a particular focus on the development of the new Clean Industrial Deal, which will be presented in the first 100 days of the next Commission mandate. While Draghi's report recognises the EU's continued general strengths, such as sound education and health systems, along with robust welfare states, it also highlights Europe's failure to convert these strengths into productive and globally competitive industries. Draghi has identified three areas for action to reignite sustainable growth. The first, closing the innovation gap. Europe can't seem to produce companies capable of disrupting existing industries or developing new growth engines. No EU company set up from scratch in the last 50 years has reached a market capitalization of over €100 billion. By contrast, all seven US companies valued over €1 trillion were created during this period. European companies invest less in research and development, and many entrepreneurs look to US venture capitalists for financing, often scaling their businesses in the US market. Between 2008 and 2021, close to 30% of Europe's unicorns, which are startups that went on to be valued at over $1 billion dollars, relocated their headquarters abroad, with the vast majority moving to the US. The second point is on decarbonisation and competitiveness. Europe suffers from a lack of natural resources and has fundamental issues with its common energy market. Electricity prices for EU companies are 2 to 3 times higher than in the US, while natural gas prices are 4 to 5 times higher. The failure of industries and households to capture the full benefits of clean energy in their bills is attributed to market rules. The EU needs a plan to transfer the benefits of decarbonisation to end users. Otherwise, energy prices will continue to weigh on growth. And while decarbonisation is an opportunity for Europe, the EU is a world leader in clean technologies like wind turbines and low carbon fuels. While it also develops more than one-fifth of clean and sustainable technologies, it is threatened by China, which deploys industrial policy, subsidies, control of raw materials, and large-scale production to outcompete Europe. According to Draghi, security is a precondition for sustainable growth. The EU needs a foreign economic policy with more extensive partnership networks to secure supply chains coupled with increased military spending via a consolidated defence industry. Financing a reset of the European economy is a daunting prospect. It would require a minimum annual additional investment of 750 to 800 billion euro to meet the objectives set out in the Draghi report, a sum corresponding to 4.4 to 4.7% of EU GDP in 2023. To put this into context, investment under the Marshall Plan between 1948 to 1951 was equivalent to 1 to 2% of EU GDP. A major sticking point is that productive investment in the EU is weak, despite ample private savings. Consequently, The report devotes considerable attention to the root causes of low investment financing in Europe, and the causes are familiar. One of these is the fragmented nature of European capital markets, meaning that the flow of savings into capital markets is relatively low. The Commission's efforts to build a capital markets union, or CMU, and banking union face major obstacles, including the lack of a single securities market regulator and rulebook for trading with inconsistent supervision and interpretations of regulations, a far less cohesive post trade environment for clearing and settlement compared with the US, and unaligned tax and insolvency regimes across the EU. The report also notes that EU capital markets are undersupplied with long term capital relative to other major economies, due mainly to the underdevelopment of pension funds. A consequence of the above issues is that the EU relies excessively on bank financing, which is less well suited to funding innovative projects while carrying several constraints. The completion of the CMU should go a long way toward addressing these shortcomings. In this context, the report advocates for joint EU funding of European public goods, such as infrastructure and defence, as well as the issuance of a common, safe asset. Joint EU funding seems unfeasible right now due to the likely objections of more frugally minded states. At the same time, there's no doubt, according to the report, that the issuance of a common safe asset would make the CMU much easier to achieve and more complete for several reasons. First, such issuance would facilitate the uniform pricing of corporate bonds and derivatives by providing a key benchmark. This would in turn help to standardise financial products across the EU and make markets more transparent and comparable. Second, it would represent safe collateral, usable across all EU member states and market segments, as well as by central counterparties and in interbank liquidity exchanges, including on a cross border basis. Third, it would provide a large liquid market attractive to investors globally. This would mean lower cost of capital and more efficient financial markets across the EU, because the asset would likely be included in the international euro reserves held by other central banks. The role of the euro as a reserve currency would also be enhanced. Finally, at the retail level, it would provide all European households with a safe and liquid asset accessible at a common price, while further reducing information asymmetries and home bias in the allocation of retail funds. This last point is perhaps where the key challenge for Europe lies: the ongoing tension between national and regional interests when coordinating policy for 27 nation states. Intuition Know How, the world's premier digital learning solution for finance professionals, has a number of tutorials relevant to the content of this podcast, including an introduction to economic indicators, an introduction to trade finance, tutorials on commodities, including electricity and natural gas, tutorials on the business of corporate banking, investment banking, and consumer banking, along with much, much more. If you would like to learn more about Intuition Know How, visit intuition.com/know-how.